This conference will now be recorded.
Okay, well, I think all of you know that we're here to talk about covered strangles today. So what I was going to do is just start with what is a covered strangle, and then I was going to do just like I did last time with the diagonals discussion, is basically just talk off of my trading plan, and I've got some diagrams here to help with the discussion and just stop me whenever you've got a question, and I'll stop myself as I go through each section. But if you got any questions along the way, just stop me. Sound good to everybody? And I'll also target we'll finish before 9 o'clock. And then if people really have that many questions that we keep going, we will. But I don't know that there will be. This isn't that complicated. Okay, so over here on the left-hand chart, um, the very first bullet here under strategy is this is a bullish or neutral to bullish trade, just like a covered call is. And the difference then from a covered call is that it's a covered call and a cash secured put on at the same time. So you really have, call it 200 shares if you want at risk rather than 100. And because you get 2 credits instead of one, then depending upon what happens to the stock price, which we're going to go through, up, down, or sideways, there can be clearly some advantages to this over a covered call. And in certain situations, there are disadvantages of this to a covered call, just like any other strategy. Um, so what I've got here on the right-hand screen, I stole this off the internet, and it's got one typo in it. The person right here in the middle, it says sell straddle, and it's actually supposed to be strangle. But at any rate, this is a flow chart of what one does with a covered strangle. And so as I'm going through my trading plan on the left-hand side, I'm at times going to point to the chart. So whether you learn better from words or you learn better from visuals, you'll get it from both sides on this. And the basic concept over here on the right is, let's assume for the sake of argument, what I'm comparing this covered strangle to is a covered call that started by a cash secured put. And so I know many of you do start your covered calls with a cash secured put, and many of you do not. But let's just assume for a moment, for sake of argument, that you do, and then I'll be comparing apples to apples. And just like you would with a covered call, in this process, you would sell your put, step one, and if the stock goes up, your put expires worthless, and then you would go on, and if you're still interested in that particular stock, ticker, index, whatever, you'd sell another put, and then another put, and then another put, as long as the stock continued to go up. So at that level, the covered strangle is exactly like what you might do with a covered call if you did it starting with a cash secured put. Now, the other scenario is the stock doesn't go up, but the stock goes down. So if the stock goes down, your put is assigned, and now you've got 100 shares of stock. So again, exactly like the covered call. Now here's where the strangle, this is a typo, this is where the strangle comes in. At this point, after you've got the stock, you're going to sell a covered call. You're going to sell a call, so you're going to have a covered call, but you're also going to sell a put. So now you've gotten 2 credits on this 100 shares of stock, in a sense, that you've got at this point. And again, one of two things happens. Either the stock goes up or the stock goes down, or it obviously can stay sideways. But if the stock goes up, then just like you would with a covered call, your stock's going to get called away, but your put is going to expire worthless. So at this point, the advantage that you would have over a covered call is you will have collected 3 premiums instead of 2, because with the covered stock, you would have gotten your first one by selling the put, and you would have gotten your second one by selling a call. But with the covered strangle, you got a third premium by selling the put. So if this is where you got to, obviously you'd be ahead with the strangle over the covered call. Now, the other thing that could happen when you put this strangle on is the stock goes down, and in this case, you're going to get assigned another 100 shares of stock. So, and your call is going to expire worthless. So at this point, you're now going to have 200 shares of stock instead of 100. And when we get back over to the trading plan, that's going to be my second bullet, is the big difference versus a covered call is you have to be willing to have 200 shares instead of 100 shares, or 400 instead of 200, or 800 instead of 400. It just depends on how big your trades are. And once you get to 200 shares of stock, now you're just going to sell 2 covered calls, or 2 calls instead of 1. So now you're going back to, at step 3 here, you're doing exactly the same thing that you would be doing with a covered call with 200 shares instead of 100. And so again, either the stock's going to go up or it's going to go down. And if it goes up, your 200 shares get called away. So you're going to be back to 0. But at this point, you're going to have collected 5 premiums. And the reason you've gotten 5 premiums is because you got your initial one from the put, then you got 2 here, you sold a call and a put, so that gave you 3, and then you sold 2 more here because you had 200 shares, so that gave you 5 credits at this point, and now you're back to 0 in terms of the stock. Or at this point, remember, we're just in a covered call situation here, and so if the stock price goes down, then your calls just expire worthless, and you're still left with 200 shares of stock, and your cost basis is going to be based on these 5 premiums. And at this point, you would just sell another 2 covered calls, etc., and go on and on. So that's just a really quick explanation of what I'm going to be putting in words over here. I'm going to be putting in what deltas to use and days to expiration and et cetera, et cetera. But let me stop here, having just gone through this visual, and ask if this is clear, if you've got questions, if there's something that doesn't seem right in this. Any comments at this point?
Well, I'm going to have a comment, right? So I guess my comment is only the fact that so far, I don't really see much different between doing it with one stock or doing it with 2. 2 different.
That's right. Yeah, and you've raised a good point that I'm going to get to, and you'll see that this is a table that I created. Everything that I found on the internet, and I mean, I looked and looked, I can't tell you how many trading plans and descriptions I looked at for covered strangles. They all have compared it to 1 covered call, and I think the more appropriate comparison is against 2 covered calls. And so what you'll see is, I'm going to go through later in this discussion a comparison against both 1 covered call and against 2 covered calls, because where it gets different is right here at this middle point, where you're selling a strangle rather than selling 2 covered calls. Instead of selling 2 calls, you're selling 1 call and 1 put. And so there is a difference versus 2 covered calls, depending on whether the stock goes up or goes down. But you're right, other than this step right here, it is essentially the same thing. And I'll show you what happens when.
What I was really getting to is, in that step, I don't see a difference between selling 2 different, in other words, selling 1 call, 1 covered call, and selling a cash secured put on a different stock. I mean, you're still going to collect the 5 premiums at the end. You're just going to collect them on two different stocks.
Well, that's assuming that, yeah, that you want to do it on 2 different stocks. I
Yeah.
mean,
Okay. Well,
yeah,
okay, fine. Well, no, go ahead.
yeah. I mean, that's how you get into a portfolio discussion of, how many shares of each different ticker you want to have in your portfolio and how many different ones do you want to watch. Like you may be watching 20 different stocks and doing covered calls on them. I'm far more likely to just do SPY and do one with more contracts so that I can, I think, simplify my life. But
Okay.
yeah,
Okay.
yeah, but you're right. Good comments. Anyone else have a comment or a question at this point? Because if you've got this, most of what I've written over here in my trading plan is going to be, I think, pretty straightforward to you. So let me go back over to the words to the trading plan and see if any other questions come up. So again, this is, oh yeah, and I should have just made the point at anywhere along here, if the stock goes sideways, obviously both the call and the put expire or the 2 calls expire, etc. So I think everybody knows that, but that's just not part of this diagram. So again, back over to the written side under the strategy, this is a bullish or neutral strategy, and you need to be willing to purchase 200 shares. And once you get them, you need to be willing to let them be called away. And theoretically, the concept here is you want to sell your shares at a higher price than you've got today. That's why you're putting a call and a put on here, is to lower your basis. But you're also willing to buy more shares if the stock price falls, because obviously you're going to go to, you're putting on another put so you can go to 200 shares. And I think the concept here is you want to get a more stable or smaller standard deviation, is probably a better word, than if you did 200 shares of stock with 2 covered calls, or just simply 2 cash secured puts of the same ticker. Because what you're going to see me get to later is if the stock market is bullish, the 2 covered calls wins, and if the stock goes down, this cash secured put, I mean the covered strangle wins. And so it really depends on how bullish you are, or how bearish you are, or how risk averse you are. Because I think I'll be able to prove to you that if you're somewhat risk averse and or you aren't bullish enough to go for it, then this actually comes out ahead of the 2 covered calls. But we'll get to that. But that's the fundamentally why you would consider doing this. Clear so far?
Yeah.
Okay.
You
Now,
make money in either direction. I mean, if it goes up for a while, you make money. If it goes down for a while, you make some money.
right, right. And the big enemy of this is going down. And in fact, maybe I should just, because you said that, here's the graph of what a covered strangle looks like. And this looks a lot like a covered call, obviously, because this is what a covered call graph looks like. But more or less, if this is where you get into the stock goes up or only goes down a little bit, you're going to make money. And if it starts going down a lot, you're going to lose money. It's just that you're going to lose a little bit less money than you would lose by either just owning the stock alone or by doing just covered calls. You'll lose a little bit on this end versus 2 covered calls, but you'll make a little more on this side. I'm sorry, I said it wrong. The 2 covered calls make a little bit more money if it goes into the green, and the 2 covered calls lose more money if you go into the red. So, but at any rate, that's the core idea here. And then in terms of just the usual stock selection, since this is a bullish trade, you really want to get into something that you believe is going to go up. And so just like I talked about with diagonals, there's many, many different ways to decide when you believe a stock is going to be bullish. And I won't get into those because everybody has their own ways of deciding about bullish stocks. Steve Zoller personally would prefer tickers that pay dividends, but honestly, you can do growth stocks also. You don't have to use dividend paying stocks with covered calls, and you don't need to use dividend paying stocks with this. So you can use stocks, ETFs, or indexes, whatever you prefer. And then just like with any other trade, I just put in here, since it's my trading plan, that it's always better to use a high volume, liquid, penny increment above $20 a share underlying stock, ETF, or index. So again, there's nothing magic about this. You're trying to pick a bullish stock is all you're trying to do, or stock, index, ETF is all you're trying to do here. I'll say, are there any questions? I'm assuming that's pretty straightforward.
Crystal clear.
Good. And then
I'm looking here and I'm thinking, you could actually hedge that downside with a lower out of the money put.
You mean putting on selling 2 puts instead of 1?
No, actually buying one. I mean, you're selling the expensive ones, but on that downside, you could take some of that premium and buy a long put to protect your downside there to some extent.
Yeah, and I think that's what. Well, I guess without the stock. Without the stock, I think that's what the tasty trade people are now calling a jade lizard, right?
That first time I heard that.
Yeah. Well, anyway, we won't get into jade lizards, but they're doing it basically because the stock market's been so bullish. If you're doing iron condors or strangles, the call side gets killed so much, and so they've tried to come up with a 3-legged strategy that better deals with bullish markets, but still has some trade on both sides of the current stock price. And it's related to what you were just saying. Anyway, that's a whole nother strategy.
Well, my protection on an iron condor is I don't do them anymore.
Yeah, that's probably smart.
Yeah.
So for entries, the strikes you choose are really what you would choose for a covered call or a cash secured put. This is not any different than that. So whether you choose your strikes based on your annualized return from the strike, whether you choose the strike based on deltas, whether you choose your strikes based on support and resistance, whether you choose them based on a percentage away from the current stock price, you would do the same thing for this. There's no reason that you would do anything different for this than you would do currently. I like to think about these more as what's my annualized return, but there's nothing wrong with any of the other many different ways for choosing strikes. You're going to see a little later, I'm going to do an analysis that assumes you're choosing a 30 delta strike, but not because I'm advocating a 30 delta strike, but just because I had to pick something as the way to make a comparison, and that's what I chose. And then again, some of you sell covered calls weekly. Some people like to put the call a little farther out. I think the most standard approach is to use a days to expiration around 30 to 45. And most people will say don't do it over an earnings announcement because then you're just gambling. But again, it's no different than what you might do otherwise. And for the covered call side of it, I tend to think if we're getting close to an ex-dividend date, I would rather have my expiration date on the other side of the dividend date, so I'm certain I'm going to collect the dividend rather than having it on the short side and either having it called away before I get the dividend or having to mess around with rolling it before the dividend, etc. But that's just for me to make it more simple. And for me, as soon as I put these on, I immediately put in a buy to close order for a nickel. I'm just kind of a believer of once if I've got a dollar or two credit, once it's down to 5, 10 cents, something like that, why would I gamble the dollar or two that I've already made in order to make literally a few more pennies? It just seems ridiculous to me.
Well,
But
that
again,
would depend. That would depend on how much time is left in the option, right?
well, and certainly the more time that's left, the more likely I would to get out of it.
Right.
When you get down to the last few days, if you have the strangle on, well, then you know that well, if one side is going to get called away or put to you, you obviously can let the other side, because it's a mile away, just expire worthless and make your extra $5. But if it's in between, if it's going sideways, I'm telling you, gamma can just kill you in those last 4 or 5 days. And so even then, I don't, I mean, I know some people like to gamble for pennies on the dollar, but I don't. I just don't see any reason to gamble. And so when it gets close to expiration, I close them out or roll them, whatever it is. But again, it's not mandatory, but this is my trading plan, and so this is the way I do it. But that's why we're talking about it, is to say you don't have to do that. I just think it's prudent. Um, and then again, my point here is that I'm just starting this trading plan with a cash secured put. You could jump into the strangle as your initial trade, just as you could jump into a covered call with your initial trade. You don't have to go through selling a put first. It's just a personal preference on your part. But I thought by this talk, I would go through the entire process, um, just so you could see all of the steps. So let me stop here. Any questions about the entries or any comments about that? Okay, that's pretty straightforward. And then here we get into the trade management. And just like I did last time, I tend to think of trading plans as you need to think about your market going in three ways. It either goes up, down, or sideways. And so you need to have a plan of action, knowing what you're going to do, whichever of those three directions it's going to go. And I'm a believer that you don't know. Yes, you may be correct that the market is bullish over the next quarter or 6 months, but in the next 30 days before this short position expires, you have no idea whether it's going up, down, or sideways. So you need to know what you're going to do. So if you're going to start, again, we're just assuming that we're starting with a cash secured put as the first step. Theoretically, at least, you would prefer to open your position after a pullback, because after a pullback, the stock or index is more likely to be going up. Now, if the pullback is what you believe to be a bearish market, obviously you're not going to enter a bullish trade if you think your pullback is a bearish market. But if it's just the normal pullback, it would be the ideal time. And then once you've sold this put, if the stock price goes up, then your put just closes out, and either you can end the trade because you don't want to trade this particular stock anymore, or you roll it out to the next month and you just use the same criteria as above, and you just keep doing it month after month and collecting your credits. Now, if the trade goes against you or goes down, then you're going to be put the stock price, and so you've got 100 shares. And at this point is where we do the strangle. We're going to sell a covered call, and we're going to sell a put using this above. And again, we're calling it a covered strangle, and it's pretty obvious what your cost basis is, that your purchase price less the 3 credits that you've now received is where your cost basis is. So that's just kind of this first step here in the process. Any questions, comments? Assume that's clear. Pretty straightforward stuff you've been doing all along. And then now that we've got the covered strangle, what happens? So one, the stock just goes sideways. so that it stays between the strike prices. And again, this is what Gil and I were just talking about. You can choose to just let the two shorts expire if you're gutsy enough. I don't. I would get rid of them when they get down to a nickel or get down to 4 or 5 days before expiration. I just, again, as I said, I don't see any reason to leave them on. Or you want to roll. You want to stay in this trade, so you're going to roll your options out to the next month. And now you're going to get 2 more credits, so you're going to keep reducing your cost basis. And I write this down at the bottom of the document, but when it goes sideways, it's really the easiest way to trade, because you're just every month you're collecting 2 more credits, and you just keep pulling in your credits. And if you got a dividend paying stock, you're pulling in your dividends, and life is good, and you'd have to do almost no trade management. And it's pretty simple. It's not the most return you can get, because the most return is if the stock is going up. So you're also getting an improvement in the stock price. But from a simplicity of managing it, going sideways is really easy. So another possibility is that the trade goes up. So it goes up to the call strike, and your stock gets called away at the call strike, just like a covered call. And your put, now this is one time when I might not close my put. I might just let it expire, because if the stock has gone so high that it's going to get called away, then there really is no gamma risk to speak of down on the low side. So I might let this one expire. And so now you have no stock. And so now you would just start all over again with another cash secured put. But if you don't want the trade to end, if you want it to continue, then you're going to need to roll your call out to the next month, and you're going to need to roll or buy another cash secured put, because you're going to continue your strangle out into the next month. So it really depends on whether you want to end the trade when the stock price goes up for whatever reason, or normally you'd want to go with it. You know, the trend is your friend. So if it's going up, normally you're going to want to keep going with it. And then the third option, of course, is that the stock goes down, and at this point you get put another 100 shares. So now you've got your 200 shares. And when it goes down, again, you've got 2 choices. Either you're worried that it's going down for a reason, so you want to get out of this trade, or you still just think it's a basic normal pullback and you want to stay in it. So if you're ready to exit, you're going to sell your 2 covered calls, you know, close to at the money, whether you're at the money, a strike above at the money, a strike below at the money, wherever you want to do it, and so that you get the biggest credit, and it's going to help you get called away. Or you want to continue the trade with your 200 shares, and so you're going to move your covered calls higher than that out to the next month using the entry criteria that we had up above. And at this point, your cost basis, you've had 2 stock purchases, so your stock purchase price is the average of the 2 purchases. And then you're going to subtract however many covered calls and puts you've sold for credits, and however much you've had to pay in the way of debits for rolling things out. So again, it's managed pretty much like a covered call. So any questions or comments on this section?
I just have one question, and it would have to do with, I guess, the way you personally handle it. When you're, let me see if I get this right now. Are you using your adjusted cost basis when you're selling your 2 covered calls?
Yes, and in fact, I've got that as a comment down below. I think people would be wise to keep track of your cost basis, so that when you're selling your covered calls, if you're going to sell your calls below your cost basis, you need to be pretty confident about where the stock price is going, or where you believe it's going, or you need to be ready to roll it when it gets there, or you really want to get out of this thing and you're willing to get out at a loss. And so it really just depends on how you're thinking about it. But the nice thing about this is obviously you're collecting 2 credits. And so as long as you're in the Strangle, you're collecting 2 credits every time, and you've only got 100 shares. So your cost basis is coming down twice as fast as it would be coming down with a covered call. And that's why I was saying earlier that, if the stock price goes sideways or goes down, it's really very clear that it's an advantage over a single covered call. Versus two, it's not, because if you've got 200 shares with 2 calls, obviously you're collecting 2 credits that way also.
Well, aren't you
Um,
really, when you do that though, aren't you really giving up most of the premiums that you already made? If you're
um,
using your adjusted cost basis as the number, let's say $1 more than that, aren't you? And you already made, let's say, $300 in premium. I mean, aren't you giving up $200 of that premium that you already made?
well, yeah, it's perfectly fair, and you're raising a good point for me that I'm writing a note to myself. Remember a couple of weeks ago when we talked about the diagonals, I said when the stock does a pullback, or in that case, when it's at a top, but there's certainly times to decide to go, quote, naked. And in the diagonal, we were talking about naked on the long call. But on a covered call or a covered strangle, you could certainly make the argument to go, quote, naked on just the stock and not put on a call or a put, because you're afraid, especially the call, because you're afraid the call is going to limit your upside. Um, there have been studies in Tasty Trade that they make on back testing, pretty compelling argument that over time, the way you make money is by lowering cost basis, and it's not from the lost opportunity cost of covered calls. So they show covered calls versus uncovered calls, and the covered calls always win over the long haul over uncovered, even in the bullish market of the last 10 years, because of the lowering of the cost basis. But on any given month or any given quarter, Gil, the point you're making is absolutely right, and it's the same with a covered call. I mean, it's no different than how you're going to manage a covered call. Once the stock pulls back a little bit, are you going to keep selling calls or not? And there is no magic formula to that. If the stock goes up, you're going to wish you didn't, and if the stock goes down, you're going to be glad you did.
Yeah, I agree. I guess it's just a personal preference. I mean, if I can sell covered calls on a stock that I own and it's above, because I only sell covered calls above my buy price. Um, and I can do it on the initial purchase of that trade. I guess I just like to keep the premium on the side, if you will, and not
Yeah.
use it as part of my cost basis.
Yeah, and so it's just, I'll call it a gamble either way you do it.
Oh, sure.
Either you quit getting the call and put premium from the strangle because you're not sure where it's going, or you continue to collect premium, but you run some risk of lost opportunity cost because you gave away a little bit of the original. And how you're going to ever know whether you, I'll say, gained more from the selling of the calls and puts, or you gained more by going naked, you'll never know until 2020 hindsight.
Yeah.
And
Oh, yeah.
it's it's
I
a
just
fair
wanted to
point.
bring it up because I guess there's two ways you can look at it.
Yep. And so then my next point here about exits, it's like any other, it's like a covered call or anything else. At some point, you may want to get out of the trade. Either the trend in the stock price is broken, the underlying ticker, you may have trailing stop losses, percentage losses, a predetermined loss. I mean, it's like anything else you own. You got to make decisions about whether to stay in a trade or a ticker or get out of it. And it's no different with this. And then, it's always a question with covered calls whether you want to be in them over earnings announcements or not. And again, we won't get into that debate for this because, you can make the argument either way about earnings announcements. Personally, they drive me crazy, which is why in diagonals I switched to trading ETFs and indexes. It just drives me crazy when an earnings announcement or some bad announcement about the company causes me to lose. But I'm not saying it. I'm not making that as a rational financial decision. It's just aggravating. So I find to not trade individual stocks over earnings to be less aggravating. But again, that's just a personal choice. Since we're getting to 8:45 here, I'm going to keep rolling. For the Greeks, positive delta is good, but there's nothing that we're doing to manage it. Theta also is good, but we're not managing it. As I mentioned earlier, personally, I think when you get down to 4 to 10 days before expiration, I don't like the risk of gamma risk to save a few dollars. So I get out of positions, but others don't. And then Vega, with Vega, generally speaking, when the market's going up, your volatility's coming down. So your sold calls, you're going to buy back at a lower price. So a market uptrend is good for your underlying stock, and it reduces Vega, which is good for your shorts. But again, we're not actively managing any of the Greeks in this. And
As
then,
long as it doesn't go up too fast.
well, but you know what? If it does, you're happy. It's like, yeah, you can say lost opportunity cost, but when just what Gil was talking about, when you sell that call, you are saying, I'm going to be happy if I get called away here. And if you get called away, you should be happy. And if you're not, you shouldn't have put the call on at that strike.
Yeah.
So, and it's also how you get maximum return, because if the stock does not make it to your strike, you do not make as much money as if the stock does make it to your strike.
Yeah,
So
good point.
you make more money by getting called away or rolling than you would make by it not getting there. And it's kind of like my earnings announcement. It may be frustrating, but it's actually it maximizes your return.
I have no problem getting called away.
Yep, yep, that's right. Or rolling. I mean, you got to pay money to roll.
You could roll.
That works too. And just if it's not obvious, it's called a covered strangle because you're selling a strangle and the long stock is the cover for the risk of the short call. But you really can look at this as, if you're used to selling strangles, you might think about this as a strangle with 100 shares of stock. Most of us are more used to thinking about covered calls and cash secured puts. So it's more likely that most of us are going to think about it as a combination of a covered call and a cash secured puts. And again, I won't go over it, but anytime as I said earlier, you got to be ready for the stock to go up, down, or sideways. And small down movements are still okay in this. You make money either way. And really the worst case scenario is a big pullback, just like it is with a covered call. And so hence it's the getting out of things and when is still your most important piece of this. So having exit rules that you know what you're going to do is important. And I saw a study, and I'm not going to repeat it and I'm not going to defend it, but basically they showed how selling calls, if the stock price went down 50% and you only had the stock, that by selling calls you only got a 25% loss. So you still lost money from a 50% pullback, but you didn't lose nearly as much, which makes perfect sense. And then in here I've got how you calculate max profit, max loss, and break even, but that's all pretty straightforward. And then to Gil's point, this bullet right here of selling calls above your cost basis, which can get really low, or as Gil said, never sell a call before your stock purchase price and just quit selling calls if the stock goes down, or get out of it, is a perfectly legitimate way to think about it. And just like we talked about with diagonals, if you want to try to time the market, you can. You can sell your calls after a rally when you think you're at a peak and you think you're getting a pullback, and you can sell your puts after a pullback when you think it's going to bounce up. If you can time the market, I'll say power to you. And lots of people try to do that. It's just it's worth noting you can try. And the other thing is you actually can trade this bearishly if you short the stock. So it's a covered strangle. You'd short the stock and you'd still sell the call and the put because you still want money coming in from selling the call and the put, but you would short the stock. I wouldn't do that. I don't do that. I don't try to do that, but one could do that if you wanted to. And then if it's not obvious, I put this little table in here just to make sure it is obvious. But if you look at just owning 100 shares with no options, obviously that's a delta of 100 and you get 0 credits. If you just sell a this is a typo. It should be a covered call. So if you've got a covered call, you've got 100 shares plus, just for sake of argument, I said a 30 delta covered call. So your delta is 70 and you've collected 1 credit. If you do 2 covered calls, you've got 200 shares with 2 30 delta credits. So now your delta is 140 and you've collected 2 credits. And then if you do a covered strangle, you've got 100 shares with 130 delta covered call and 130 delta put. So you're staying at a total of 100 and you've collected 2 credits. So when you look at this, we don't really, well, we'll see. I've got another table we'll pull up. But when you look at this, just on at least on the first month, if you're bullish, Gil, to your earlier point, two covered calls are going to be more bullish than the covered strangle because your delta is 140 versus 100 and you've collected the same number of credits. But the flip side is if the stock's going down, then you're also less bullish with 100 and so you're going to make more money with it going down. And I'll show you an interesting table I did about this, but these two strategies are pretty close. I think, as I said earlier, I think the point here is that if you want to minimize, not minimize, but reduce slightly your downside risk and reduce slightly how much you can make on the upside, then a covered strangle is the thing for you. If, on the other hand, you want to be a little more aggressive to the upside and you're not as worried about, you're willing to take a bigger loss to the downside, then 2 covered calls is the better strategy. And so it really depends on how risk averse you are or how aggressive you want to be in terms of making profits. So comments, questions at this point? Because this is all I have on my trading plan. The last page of the trading plan is just this chart that we've been looking over here on the right. And I have an analysis that I've done comparing these strategies, but it's kind of an incomplete analysis. So this is the bulk of the discussion. All seem pretty simple and clear?
Yeah, this is great.
Good.
This is good.
So I'll show you the analysis I did and where it's lacking. What I tried to do is say, okay, we're going to compare a covered strangle versus having just 100 shares, whether we start off with 1 put or 2 puts. In other words, we're heading to 2 covered calls, or we're doing the covered strangle. And we're going to look at it over a quarter. And what might happen, every possible combination of what might happen. So one thing that might happen is the stock or the underlying index, whatever it is, goes up 3 straight months. And I'm just making the assumption, well, that each of these ups and downs, it goes up enough that if you have a call, it's going to get called away. And if you have a put, it goes down far enough that you're going to be put the stock. Obviously, it might go in between, but I can't truly cover an infinite number of combinations. So I just tried to cover some of them and see what would happen. So I looked at what happens if it goes up for 3 straight months. What if it starts down the first month and then goes up for 2 months? Or what if it goes down for the first 2 months and then up 1 month? Or it goes down all 3 months, and then you've got the other combinations, 1 up, 2 down, 2 up, 1 down, 1 up, 1 down, 1 up, and 1 down, 1 up, and 1 down. So I was trying to think through what happens with each of these 4 strategies and which one comes out ahead at the end of the day. And so this is qualitative. If anybody wanted to take on putting quantitative numbers, which you could do from a looking at toss or any of the other you know option chains, you could figure out pretty much what you do. But the way I coded this is you start with 100 shares, so it goes up. So we've got 100 plus in a sense. It's gone up in value. It's gone up again a second month, so now it's up 2 pluses. And at the end of the third month, it's up 3 pluses. Whereas when we have all of these are just selling puts. So at the end of 3 months, Gil, the one where you were heading down the path of 2 covered calls, you've gotten 6 credits on this one. Whereas with the a single covered call and a single covered strangle, you only have 3 credits. So I rank ordered them, and qualitatively, I think in this case, when it goes up 3 straight months, you're going to come out ahead by just having owned the stock. You're going to be second by having the 200 shares or the two cash secured puts. And then, of course, the 1 cash secured put's going to come in last. But then what happens is when you start doing more down months, like let's say when you go 2 down and 1 up or 3 down and 1 up, when you go through this, I concluded that the covered strangle, in fact, was number 1, and the 2 covered calls was number 2. And we don't have time to go through all of the pluses and minuses, but when I went through it, I concluded that, but it makes sense because we're starting with a lower delta with the covered strangles. We've got some coverage to the downside, and so when you're going up, the 2 covered calls wins, and when you're going down, the covered strangle wins. And when you start getting into a more neutral position, you start getting into some ties, and some of these down here where you've got up, down, the 2 covered calls tends to win. And so I think that it gets back to, again, as I said, the more you're wanting to be aggressive on the upside and willing to take a little more loss on the downside, the 2 puts with 2 covered calls makes more sense. And if you want to have a lower standard deviation with a little less return but a little less downside, then the covered strangle makes more sense. And at least in this quarter of doing all of these ups, downs, and sideways, or not sideways, but all these ups and downs, I came to the same conclusion I had started with, which was just that. So I know this is a crazy looking chart, but I literally spent the time to try to figure out what happens in every scenario over a quarter and which of the strategies come out the best and which ones come out the worst. So that's it for me. Anybody has any other questions or comments?
Oh, yeah.
That's it.
Oh, yeah. I'm looking at the end of month 1, just for an example. And I'm looking, you can't see where I'm pointing, but yeah, let's say 1 down, 2 up.
Okay.
Okay, and that on that row there. What is the 100 signifying?
So what happened is at the end of the month, I had 1 cash secured put, and the stock was put to me because the stock price went down. So
Okay.
I was put 100 shares, and I got 1 credit from the put. And this
Okay.
one I was put 200 shares and had gotten 2 credits, and obviously the Strangle I also got 100 shares and got 1 credit. And my just stock alone, it went down. So I've got a minus on that one because it's gone down.
Got it.
And then the next month it goes up. So when it goes up, I I had to put the calls somewhere. So I just set the calls at such that the stock went up far enough to get called away at wherever our strike prices were. So now we're at 0 again on all of these, and we've got different numbers of credits. Of course, in these down months, the true profit and loss, which is the blank column here with the numbers, would be how far the stock really went up and where you set your calls, etc. But I just didn't have the time nor the energy to put real numbers. And so my rank ordering is qualitative. And if it came out differently with numbers, I wouldn't be surprised. But the qualitative rank ordering just seems pretty intuitively right to me. But again, I'm not advocating making a strategy decision on intuitively right, but that's all I got for you.
What I can see here now, and this helps, is that as we move from left to right, the number of CR credit keeps incrementing
Correct.
as you keep collecting credits or premium.
Correct.
Okay.
Yeah, I should have
Okay.
said that. So what
Yeah, you can't
happens
see.
is in every scenario, when you've got the 2 covered calls scenario, you're going up by 2 credits every month because you're always selling 2 calls or 2 puts. And for the 1 covered call scenario, you're always incrementing by 1 credit. The cash secured put the covered strangle is different. Sometimes it goes up by 1 credit and sometimes it goes up by 2 credits, depending on whether you're in the strangle mode or whether you've already been put 200 shares so that you're
Yeah.
selling 2 calls. So it's the one that has some variability in terms of the number of credits that you've received by the end of the quarter. Literally, as you can see, sometimes it's 3, sometimes it's 5, sometimes it's 4, whereas the others are always 3 and 6.
Oh, yeah. Yeah. Do you ever do, I know it's a separate topic and I don't want to go too much longer. But do you ever do coverage straddles?
The answer for me is no.
Okay.
I've
Because
never tried.
for the life of me, I can't figure out why anyone would want to do that.
I, it isn't obvious to me either, and it's been so non-obvious that I've also never studied it, and I've never read why people do it.
Yeah.
So I can't even give you a good argument for why yes or why no, because the truth is I just don't know.
Yeah. Okay. So we're in the same boat.
Yep.
All right. It was very good, Steve. Thank you so much.
This is good. This is
All
good.
right. You're welcome. And the other thing that if nothing else, maybe some of the folks either live or eventually on YouTube will get a sense for there's a lot of different ways to create a written investing plan or trading plan, whatever you want to call it.
Yeah.
But there's advantages to do it. And I'll tell you, both of these presentations that I've done, I've told my better half that I've really enjoyed doing this partially or mainly because it's forced me to improve my trading plan so that when I show it to someone else, I can feel good about it. And
Yeah.
so it's actually helped me. The classic, the teacher learns more than the student. And
Yeah.
so I really believe I've improved my trading plans by doing these 2 presentations.
Yeah. Yeah. I could understand that. Well, that's good. I'm glad everybody got something out of it. I'm going to pause now the recording because it takes about 15 minutes for this thing to actually do whatever it's got to do. So let me stop
Okay.
it now. And thank you again very much.
You're welcome.
Yeah, this is very good. You are going